if you go back in history, Aristotle spoke about things that is like value investing. He said that the aim of the wise is not to secure pleasure, but to avoid pain. And this is exactly what value investors do. Value investors don't care about maximizing return, they care about minimizing risk.
Hello and welcome to episode number 49 of the Rose Bros podcast, where the idea is to connect with other entrepreneurs, athletes, and interesting people to help you learn a thing or two, all the while enjoying some smooth Rose Bros coffee. This episode we are joined by Dr. George Athanassakos, Professor of Finance and the Ben Graham Chair in Value Investing at the Ivey Business School. He is also the founder and managing director of the Ben Graham Center for Value Investing and the founder and managing director of the Center for the Advancement of Value Investing Education. Prior to joining Ivey, Dr. Athanassakos spent a number of years at various research-related positions with banking and trust companies in Canada and Greece, and taught at York University and Wilfrid Laurier University, where he was a professor of finance and founder of Laurier's financial planning program. Dr. Athanassakos has a BA from the School of Industrial Studies of Thessalonica, Greece, and a master's degree in MBA, as well as a PhD in finance from York University. The Financial Planning Standards Council has bestowed Dr. Athanassakos with the Financial Planning Canada Fellow distinction for his outstanding contribution to furthering the organization's mission. He's also a fellow of the Quality Shareholders Initiative at the Law School of George Washington University in Washington, D.C., and is the only Canadian to receive this distinction. Dr. Athanassakos has been ranked among the top 10 researchers in Canada by Research Published in Financial Management and among the top 10 Canadian professors by the Globe and Mail. It was a cool episode as we discussed the origins of value investing from people like Ben Graham to Warren Buffett, Prem Watsa, and Seth Klarman, what makes a good business, life and investing advice from Warren Buffett, career advice, and a lot more. Enjoy! Dr. Athanassakos, good morning.
Good morning, Trevor.
How are you today?
I'm fine. It's getting too cold for me. I'm Greek. I like warm weather. This weather is giving me headaches.
Absolutely. I think Canada may be one of the coldest countries you could have picked to settle in.
I know.
For anyone listening, Dr. Athanassakos, you are a professor of finance at the Ivey School of Business, the University of Western Ontario. You are also a chair of the Ben Graham Value School of Investing, but maybe I'll just let you explain in layman's terms what you do day to day.
Well, I was appointed to this chair to start a program in value investing, an academic program in value investing. I developed the rigorous, academic program in value investing. Also, I'm trying to spread the word outside Canada. I started a center in Greece to emphasize Europe, and we're in discussions to start something in India because people don't understand what value investing is. And so my day-to-day is to teach students value investing, make this program very popular. And then I have also the center where we organize events. So there's a lot of work. Now, with the COVID, we got to start moving things online. This needs new experiences, new skills. And so it becomes very laborious and intensive, I guess, in terms of how much time I spend on this administrative stuff. And then I write, as you probably know, I write for the Globe and Mail, I write for the Post, for the Canadian Investment Review, I publish in academic journals. So, and then I travel a lot and I give lectures and speeches around the world. And I just finished writing a book. So I have many balls on the air. I'll say a few things about the book later, I guess, because it is a unique book and it is the first ever academic book in value investing. And I hope this book encourages universities to start teaching value investing.
Value investing is more of an approach to investing, I guess you would say, but how would you describe the term value investing to somebody out there?
Well, value investing is it's about stock picking. Like how to find, it's a process that you follow to find and buy stocks that trade significantly below intrinsic value. How to find and buy stocks on sale. As you probably know, Ben Graham used to say that a value investor wants to buy a stock that is worth $1 for 50 cents. So the value investing is a process And it's actually a three-step process, but involves a lot of in-depth fundamental analysis.
Mm-hmm.
And it's what's referred to as a bottom-up analysis. That is, you start looking at individual stocks to understand the business, to understand the management, to understand the competitive situation, the competitive advantage, the barriers, to understand the company's financial exposure. So these are very much in-depth analysis, fundamental analysis. It has nothing to do with projecting growth rates and what's going to happen 10 years from now. No one knows what's going to happen 10 years from now. We know what's happening right now. So this is what it is.
It's a lot more about studying the fundamentals of a company rather than what your gut thinks it's going to do or what you project the company is going to do.
Yeah, there's no projections. We feel that humans are not good in projecting. So we base all our analysis on historical situation and what's happening right now. And we like to look at the big picture as opposed to, all these news releases and these micro things and the noise that happens out there. We don't care about the noise. We don't care about whether Intel came up and beat earnings by 1 cent or missed earnings by 1 cent. For us, it's irrelevant for us. For us, I guess what's important is the bigger picture, that is, does Intel have the right business model?
Right.
Do they have competitive advantage? Are there barriers to entry? Is Intel well managed? Is it conservatively financed? So these are bigger issues, questions that we care. And then for us, the stock price plays no important role. What's important for us is the difference between the intrinsic value and the stock price.
Mm-hmm.
And if the stock price is well below the intrinsic value, then we buy. If not, we don't.
Mm-hmm.
Now, the difference between the intrinsic value and the stock price is referred to as the margin of safety. At the time of Ben Graham, the margin of safety was 50%. That's why he said we buy one stock for 50 cents.
To simplify, it's kind of like buying eggs at the supermarket when you know they're worth $5, but you can buy them for $2.50.
Yeah. Right now, probably people are using more, a quarter or 1/3. Okay. So if the stock is worth 10, we will not start buying until it hits 666. And the margin of safety basically is something we borrowed from engineering, and it protects the downside. Because, when you calculate intrinsic value, there's a lot of assumptions, I guess, about the future. Many things can happen that we don't know. Actually, there are many things that happen that we know we don't know. Mm-hmm. And there are many things that happen that we don't know we don't know.
Yeah.
And the things we know we don't know, we can hedge. But the things we don't know, there's nothing we can do. And there's no diversification, nothing I can help you about this. Whereas when you take 1/3 of the intrinsic value, you've taken out a lot of uncertainties, a lot of things that may happen that you don't know. Mm-hmm. I remember when we had one of the speakers, I guess, in my class, because I do invite speakers every year in my class, legendary value investor, Walter Schloss.
Yes, I was going to ask you about him.
One of the students asked him, what's the most important thing in investing? And he said, don't lose money. Because once you lose money, it's very difficult to recover. If you go down by 50, you got to go by 100%, right? Mm-hmm. So the margin of safety protects your downside, prevents against losing money.
Right. I think that's it is the first rule from Warren Buffett is don't lose money.
Yeah. Maybe Walter Schloss got it from Buffett, but right. But Walter Schloss was older than Buffett, so maybe Buffett got it from Walter Schloss.
Right. On a side note, they both studied under the famous investor Ben Graham. Who was Ben Graham and why is he important to the approach of value investing?
Ben Graham was the first one, I guess, who formalized this process of value investing, even though he was not the first one to talk about in terms of value investing terms. John Maynard Keynes was actually a value investor, but he never articulated actually in a book like Ben Graham did.
Really? Okay.
And in fact, if you go back in history, Aristotle spoke about things that is like value investing. He said that the aim of the wise is not to secure pleasure, but to avoid pain. And this is exactly what value investors do. Value investors don't care about maximizing return, they care about minimizing risk. And the margin of safety helps you minimize risk. So Ben Graham, he studied at Columbia. He got his degree there, and then he went and worked in the industry. He started the company Graham-Newman Partnership. Then he went back teaching at Columbia. And his most famous student is Warren Buffett.
Yep.
But also he had other famous students like Walter Schloss, Erving Kahn. Both are legendary value investors who lived very long. I mean, Walter Schloss died, I think, 96. Erving Kahn died 107.
That's awesome.
That's another thing I say about value investing. You know, value investing helps you live long because that's a balanced way of living. You know, Erving Kahn actually was his first RA for Ben Graham. And what, you know, it's interesting, like you see a man like 100 years old, and he still, you know, loves Ben Graham. He wants to serve this man, you know, he admires him, you know, so I had meetings with Erving Kahn, and I went to his office and I interviewed him and I taped the interview. And you can see him actually pointing to me to a book. You know, Ben Graham is known for writing 2 books, Security Analysis, which I think he wrote in 1939, and the security analysis, I guess, sets the framework for fundamental analysis. And then in 41, I think, he wrote The Intelligent Investor, which was more about philosophical, about how to approach investments.
Right.
But he has written other books as well about foreign exchange, about commodities. So Erving Kahn was pushing me to take and make the other books as popular as the first 2 books.
That's cool.
It's amazing how much the students loved Ben Graham. You know, it's just amazing. So Ben Graham says that, you know, when you buy a stock, you don't buy a piece of paper. You buy a piece of the company, and you have to understand a lot about the company. You don't buy as a trader. You buy as an owner. So you got to understand a lot. As an owner, you've got to understand a lot about the company. That's why value investing implies a small portfolio, not too many stocks, because it's humanly impossible to understand too many businesses. And then he said, you know, the market goes up and down many times irrespective of fundamentals. And he likened like the market movement as Mr. Market, like a crazy person.
Like your crazy neighbor.
Yeah, crazy neighbor. He says, don't follow these crazy movements, you know. Take advantage of them. So when everybody panics, you look for opportunities. When everybody's exuberant, you are careful and step back. You're more cautious. And that's why for Buffett, for Ben Graham, was very important to have the right temperament, the right personality, to be able to control your emotions. Because to be a good value investor, you got to be contrarian. You got to go against the grain, okay, against what the herd is doing. You know, as humans, we like to go with the herd. The herd goes this way, we say, well, maybe they know something, I'm going to go with the herd. As Seth Klarman says, the consensus in the long run is wrong.
Absolutely. Yeah.
And you're never going to outperform, especially as a professional, if you do what everybody else does. If you want to outperform, you got to do something different. And of course, the last thing, which I already mentioned, is the margin of safety. That is, always have a margin of safety when you make investments that protect your downside. For Ben Graham, investing based on careful fundamental analysis with the expectation of profit and with some protection against your capital, for him that was investing. Anything else, he said, is speculation.
Right.
So his work is important because he started the whole trend on fundamental analysis. He started the Society of Financial Analysts. He was one of the founding members of the Certified Financial Planner designation. Without him, we're still looking at price trends, volume trends, face of the moon, and all these kind of things. He formalized and gave a structure in fundamental analysis in the profession of fundamental analysts.
He kind of was the originator of a theory that a lot of very famous investors and some of the wealthiest people on the planet today follow nowadays, long story short.
Yeah.
His books have been read by most of the top investors, and long story short, Ben Graham, that was his contribution to the investing world.
Yeah.
How did you get interested in the subject?
I didn't know anything about value investing. I mean, growing up in Greece, and now that I know what value investing is, and I look back at my life growing up in Greece, Actually, I was a value investor without even knowing that I was a value investor. I had the personality, the temperament of a value investor. I was contrarian. I mean, even in grade 3, I was going against my peers. I mean, I just was doing my own thing. I was patient, I was disciplined. I had an inclination towards finance. I mean, I dealt with my family from young age. I dealt with my families buying properties, family savings. My parents were not interested. But again, I mean, I didn't know what value investing was. I was just doing it because that was my personality. So I went to university. I finished an undergraduate in economics in Greece. Then I wanted a higher education. I couldn't get this in Greece, so I came to Canada. Now, why I came to Canada? We're not from a wealthy family, so I came here because my uncle was here, and I stayed with him.
Okay.
And so I stayed with him, and I enrolled in a master's program in economics part-time first, because I was working at the Eaton Center selling hardware to make some money.
Yep.
After I made some money and I got a big scholarship at the university, I went full-time. I got a master's degree in economics. I wasn't happy actually with the master's degree in economics. I thought it was too theoretical. And then I said, maybe I'll try an MBA. So I went and got an MBA, which I loved. I loved the finance. I loved the investment part of the MBA. And then I went back to Greece. I got married to my lovely wife, Despina, and now we're married for over 30 years, and knock on wood.
Yeah.
And I worked there at the head office of a bank as an analyst. I worked for a year or so, and then I didn't like it very much. And we decided with my wife to come to Canada because we thought there were more growth opportunities for us in Canada. I came to Canada. I got a job right away as an economist for a major trust company in Canada. And I became the manager of the economics department. And then after 5-6 years, I realized I had learned everything I was supposed to learn. I didn't see that I would learn more in this job. I was always attracted to academia. I already had a master's in economics, had an MBA. I said, I'll try get a PhD. So I got the PhD program. It was a joint program between U of T and York. Now, when I was in Canada, I started investing. And again, I didn't know what value investing was, but I was investing basically based on in-depth analysis and with my characteristics of a value investor. So as an individual, I had the characteristics. And then a big thing happened in my life. So the first thing that happened in my life is marrying my wife. Yeah? That's, as Buffett says, your biggest decision is who you marry. Especially one with low expectations. And we both of us were young, were naive. We have very low expectations.
Yeah.
So the second thing that very important happened was my decision to leave Greece and come to Canada. I mean, looking back now, I'm saying to myself, how did I do this? I mean, I came to Canada, no job, no money. I had to stay with my uncle again.
Yep.
But I got the job right away, so that was good. And the third big decision in my life was meeting Prem Watsa. Okay, meeting Prem Watsa.
That's cool.
Prem gave a lot of money to the university to find an academic who could develop value investing. I think the university liked this constraint on money, but they couldn't do anything because Prem, as a value investor, he realized that unless we've got someone who develop an academic course, value investing will never become respected at the university level. So the university took a number of academics from around the world to meet with Prem and chat with him, and one of them was me. Prem did not like anybody but me.
Really?
He liked only me. And he liked me because he sensed that my personality was like value investor. I had written also a book on equity valuation, more an academic book on equity valuation, which, however, even though it's an academic book, I do a lot of fundamental analysis in the book. And he asked me for a copy of the book, and he looked at it, and he read it, and he liked it. So then we had a meeting. He was talking to me about, how I feel about market efficiency and the things that happen in the markets. He liked, I guess, what he heard. With another meeting, and we're talking about risk management and about beta, which they don't like.
Yep.
And he liked what he heard. In the third meeting, I'm in the boardroom and waiting for him standing up like this. And he comes into the boardroom and he comes to me and he hugs me. He gave me a big hug and says, George said to me, where have you been? I've been looking for you for years. Where have you been? He's such a warm person, Many people think he's aloof. He's very passionate about value investing. He's a very warm human being. And I love him much. Anything I want, he helps with the program here.
That's cool.
He's given us money to run a value fund here. He says to me, George, can you develop an academic program in value investing? I said, I'm a full professor, so I don't care about the blacklisting. I reached the top of my career. So I said, I'll try. So for 1 year, I was going around talking to value investors. I talked to Irving Kahn, I talked to Walter Schloss, to William Brown, and others.
Warren Buffett also, probably.
Warren Buffett too, yeah. And so I realized that what they were saying in a very descriptive way, with all the experience they had, the intuition they had, the gut feeling they had, made to me a lot of academic sense. Could read between the lines that I can quantify actually this. I can quantify it. And so I quantified the valuation process they were having in their minds. And I show actually in my class in the book that I wrote, how what one learns at the university, how actually converges in what value investors do, subject to some assumptions which are really actually more realistic than what they do at the university. So I developed, I think, a very rigorous academic program in value investing at Ivey. I do believe in stock picking. Okay? I believe that stock picking with the right process and the right temperament works. And most people who talk about value investing is dead don't understand actually what value investing is. That's the problem.
I was going to ask you that because there is skepticism towards value investing. Some people think that it's an outdated approach and that maybe it doesn't work as well now in the modern economy.
That's the thing, I think they don't understand what value investing is. And not only the layperson in the streets. The value investing process has 3 steps. In the first step, you screen stocks to end up with stocks with desirable characteristics like low price to earnings, small cap.
Not much debt.
Yeah, not much debt. Well, you do the screens because, I cannot really value 1,000 stocks.
Yep.
But when I screen stocks for some characteristics that I like, I end up with 30 stocks, 20 stocks. And now I take these 20 stocks in the second step, and I value each stock in depth using fundamental analysis. Through the valuation, I arrive at an intrinsic value. In step number 3, I buy only the stocks that are truly undervalued, because in the first step, you don't get truly undervalued stocks. You get only possibly undervalued stocks. That is, a stock can have low PE because simply it's a bad stock.
Right.
So in the step number 3, having determined intrinsic value, now you say, okay, do they meet the margin of safety? If they meet the margin of safety, then you invest. If not, you wait. You don't invest.
And this is in contrast to the popular opinion that all stocks are priced appropriately in the market at all times, and there's no opportunities for investors.
That's the problem with market efficiency, that value and price are always the same.
Right.
But they're not.
Right. Okay.
What they only know, and they objectively determine, is what stocks they can get from the first screen, from the screens. And they say the low PE stocks, I call them value stocks because these are the stocks from which value investors tend to buy. And the high PE stocks, the high PE group, I call them growth stocks because I know value investors don't buy high PE stocks.
Right, because there is no discount to the price earnings ratio, therefore it's a growth stock at the moment and doesn't present as
we know that value investors buy from the low PE group. They don't buy all the low PE groups,
right.
They buy from that group.
Right.
And we know value investors don't like high PE stocks because they feel they're expensive. And they don't buy from the high PE groups. So academics call the high PE growth stocks and the low PE value stocks. And all the research that has happened in academia is about the first step, the low PE versus the high PE. As a result, the public out there thinks that value investors buy low PE stocks. Well, yes, we buy low PE stocks, but we don't buy all low PE stocks.
I see.
Even if I do some study now and I show that the low PE underperforms, it doesn't mean value investing doesn't work. It means I can still, like as a value investor, I can still find from this group of this, 50 stocks, I can still find one that, based on fundamental analysis, that is going to make me money. So that's, I guess, one problem. That's a misunderstanding of what value investors do. That is, even if the low PE group underperformed the high PE group, it doesn't mean that as a value investor I cannot find truly undervalued stocks from this group. And the second problem is that what I see and I read is that people think that this value investing underperformance is like a secular thing, it's a long-term thing. When in fact, I think it's more cyclical, because it seems to me from what I've looked at and researched that value investing does not do well in a low inflation, low interest rate environment. For a number of reasons, I'll give you a number of reasons. The price to earnings ratio is a function of interest rates. Like you can derive it actually mathematically from the equity valuation model.
Okay.
It's a function of interest rates. As rates go down, the PE goes up. So now, with interest rates close to zero, all the PEs have risen a lot. When you start now sorting by PE, and you want to focus on low PE stocks, what happens is all these low PE now have low PE because they're really bad stocks.
Right.
So that's one problem, that they show underperformance of value the last 10 years because rates are low, zero. And the second thing that happens is that, again, the PE is a function of the growth rate of going forward. So the low PE implies low expectations, the high PE implies high expectations. So the high growth expectation of the high PE interacts with interest rates. So when you have when you forecast high growth in the future and you've got low discount rate, present value looks really high.
Yeah, for sure.
So interest rates and growth interact to benefit growth companies as opposed to the value companies.
Warren Buffett, he started out strictly as a value investor, buying low price to earnings ratios and whatnot, but his thinking evolved more into buying brands and companies along the way. Do you think that the strict value approach is a little outdated, or do you think it's still relevant?
No, Warren Buffett started as a Ben Graham investor.
Right.
I call actually the Ben Graham part of investing more as an opportunistic value investor.
Okay.
So Warren Buffett started as an opportunistic Ben Graham investor and made a lot of money.
Yeah. Yep.
So he was buying his low PE stocks, undesirable, obscure stocks, and then he became very rich. He could no longer buy the small cap stocks, the less liquid stocks. So he was forced by his wealth, I guess, to go and start looking for good quality companies for the long run. I mean, the way I look at it is there are two, for the first step of the value investing process, there are two approaches. One approach is low PE, small cap for the screens. And the second approach is, well, I can violate some of these requirements for the screens as long as the companies have well-defined competitive advantage and barriers to entry. So Buffett, he says, okay, I know I'm going investing now in larger cap stocks, I'm investing in higher PE stocks, but I do this because I think these companies have barriers to entry and competitive advantage. And companies with huge sustainability and competitive advantage can still be undervalued even with a higher market values and higher price to earnings ratios.
I see.
Now, I mean, I think, like I said, it's more difficult these days to find value stocks, even though I think those who are passionate and disciplined and carefully do their own work, their homework, and are independent, you can still find a lot of value. I mean, we find value, the students find value in my class, right?
Yeah.
So,
Yeah.
but it's more difficult, like, because, as I said before, of the low interest rate environment. The low interest environment is a bit more difficult.
You think Buffett, he transitioned more to a kind of a growth, or not growth, but he started buying brands for the long term more because he had a ton of money, or was it kind of a different?
Because of the size,
Oh.
I mean, like, for example, when I tell my students, I guess, what are my benchmarks for the screens? Well, I want a P to be less than 15 times. I want a price to earnings less than 1.4. I want market cap in the US less than 1.4 billion.
Yeah. I
mean, for Buffett to buy a company market value 1.4, he has to buy the whole company.
Right. Yeah.
It's like these are like change money.
Yep.
So he doesn't want to buy companies, okay? He just want to invest in companies. That's why he can only buy the huge companies, as long as they have barriers to entry.
I see. I've read that Charlie Munger was kind of the influence on Warren in that sense, and that he influenced him into buying brands, but it sounds like it was more kind of
value investors don't believe they know everything. Okay? That's why one of my checklists is talk to someone you trust, because we don't know everything, we don't have all the answers, and it's nice to partner up with someone you trust and you believe in and you respect, and that's why Buffett says, partner up only with people who are better than you.
Yeah. Yep.
Because this is where you move up as opposed to move down. Another thing I want to add that not many people understand is that as an opportunistic investor, as a pure bank investor, you buy and sell based on whether the stock's above or below the intrinsic value, right? Buffett says, and the bank investors have normally a holding period 3 to 5 years. Buffett, if you look at what Buffett says, he says, my holding period is to infinity. Why? Because the stocks he buys has such high degree of competitive advantage sustainability that the intrinsic value is always ahead of the stock price.
Yeah.
The stock price never goes above intrinsic value to sell. I mean, he said that I should have sold Coke because it did went above intrinsic value, but the stocks he buys tend to have such a high sustainability that the intrinsic value is always ahead of the stock price.
Interesting.
So he never goes above the intrinsic value, so he never sells.
Right. That's interesting. I mean, a lot of people criticize the value approach, I guess, nowadays, but it sounds like there's just a misconception on what it truly means.
They don't understand, and when you talk about human nature, the role of their eyes, I don't know, humans are so rational, you don't care about human nature. But humans are not rational. Like, people got Nobel Prize because of this.
Okay? It's so counterintuitive because you have the wealthiest people, the best investors in general are value investors or started out that way.
Yeah, I mean, you look at very wealthy people. But see, the thing is that also Buffett says that being successful as an investor, you don't need to be Einstein. You need to have just reasonable intelligence. And that's why he says, if you have an IQ of 150, sell 30 points to somebody else. You don't need it. And he says, most successful people are intelligent, but intelligence has nothing to do with the success. Instead, what allows them to have success is how well they understand human nature and institutional biases. When you look at what he says about his successor, he says, I want someone who understands human nature and institutional biases. Human nature is the most important thing in investing. I mean, you can be the best screener, the best valuator, but when you panic, you get greedy, you're not disciplined, you don't do your homework, you're never going to be a good investor. I think the most successful investors are those that have the right character, the right temperament.
Lots of people like to say they manage money for a living, handle people's money and whatnot, but it's really hard to beat the S&P 500. Do you see many people that actually beat the S&P 500 consistently for 20 or 30 years?
Yeah, I think Greek philosophers used to say, that you never judge someone's life until they die.
Yeah, yeah, for sure.
So the thing is, you have to look at somebody's full life to make a decision, because somebody can be lucky over a business cycle and beat the market and then
Exactly.
changes. Many investors screwed up in 07, 08, right? People with long history, they screwed up. So you got to look at somebody's life. So that's why I want to look at people who either have died or they have retired now, right? So if you look at Irving Kahn, Walter Schloss, Peter Candle in Canada, and of course, I think Warren Buffett, in some sense, has retired. I don't think he's making decisions anymore. I think the other guys are making decisions. So I think he has retired from making decisions. He's still there as figurehead, but I don't think he's making decisions. And that's why also he's getting older now. He's like 90 years old, right? So, and Munger is 95. I think his health is, the thing, was with sad, is you look at these people, and other value investors, even Irving Kahn, when I met him, I guess, many times, and then the last time I met him when he was 107, and then he died after a little bit. The body was dying, the brain was 100%. It's like a car, where the engine is keep going, but the body of the car is falling apart.
Yep.
So all these people have, Walter Schloss had managed money for 50 years, right? 50 years. And he beat the market, I think, by 5% after fees.
Right, exactly. That's so hard to do.
Yeah. The same with Peter Candle. And if you look at Peter Candle, have you heard of Peter Candle?
I think I've read about him. Yep.
Yeah, actually, you can go and watch on my website. I have the only video of Peter Candle talking about nets. Very colorful Canadian, and you can read actually his biography, his life, I guess. There's a book which is called "There Is Always Something to Do," and talk about him. So he was Canadian. He operated in from Vancouver, but he had also operations in London, England.
Okay.
There were like 15 years, I think, maybe 20 years, that he really underperformed. Very much underperformed. But if you look at his whole life, he outperformed by a lot.
Do you see many people, because you met most of the famous value investors and you've had a ton of students and you met tons of investors, how many people do you actually meet that consistently beat the market?
I think, William Brown, William Brown.
Okay, yep.
It's a company, a 100-year-old company that survived through business cycles and have done very well.
But not many people do. We're talking like...
not many people do.
Yeah, exactly.
I think Seth Klarman has outperformed.
I have his margin of safety right here, actually. Yeah.
Oh, yeah, the bootleg copy over the internet. You cannot buy the book anymore.
No, I can't afford the book.
And what's more important, is that these guys outperform even if they have like 30% cash. So it's very difficult to outperform the S&P because the S&P is fully invested.
Yeah, exactly. Yeah.
Right? Like for us, I guess, if you look at the Ivey Value Fund that the students run, we basically, if you look at the benchmark and us, we're about head to head, but we are 60% cash.
Yeah, for sure. That's tough.
So, and I want to have cash because for me, it's more an education vehicle. I want to invest money every year for students and do the best ideas. I don't want to invest now for this group of students and I have no money next year for the other group of students.
For sure.
If putting like 60% with 1%, then the other 40% must be doing pretty well to get benchmark returns.
Yeah, absolutely. Do any investors in Canada stick out to you other than, say, Prem Watsa? Are there any others that really...
Yeah, Francis Chu, I guess.
Ah, yes.
Francis Chu.
Yeah.
He's a very idiosyncratic investor. He's like a robot, man. Like, he has no emotions about stock market. He's amazing. He's actually he's now buying into insurance companies and he's trying to do a mini Berkshire Hathaway, I think, fund. I think Kim Shannon is a good investor for Siona Asset Managers. Burgundy has historically done very well. I don't think it's done very well recently. There was a lot of change in the company, so I don't know what's happening there. But historically, they were doing pretty well.
I was just reading a book called The Outsiders. I don't know if you ever read this one, but Teledyne?
Yeah, read it, yeah.
He was another example of someone, maybe not a strict value investor, but someone who I think his annual compound rate of return over 30 years was like 25%, which is incredible.
Yeah. Yeah, that's why you need to look at people over a whole life. Because if you look at Peter Candle like over 10, 15 years in the middle of his life, you're going to say, oh, he's not doing very well.
Right.
But if you look at his whole life, now, I don't know if you read, yesterday, I had an article in the Financial Post.
I didn't see it. No, I'll have to look.
You can go to the Post, actually, and look at it.
Absolutely.
I've done some research. I looked at CEOs who behave like value investors.
Mm-hmm.
I mean, the idea basically like the thing that outsiders did, okay?
Yep. Yeah.
I tried to find like CEOs that behave like value investors. And I was trying to figure out like what can I use as a proxy that somebody is a value investor. I mean, the best thing to do is to see when they buy back shares or they buy other companies. Do they pay high PE or low PE?
I see. Yep.
When they buy for their own account, insider trading, do they buy at low PE or high PE? But I decided to look at something different because most people may have looked at this. I think the outsider was looking at PE, I think. I looked at goodwill on the balance sheet, goodwill to assets. Companies with high goodwill means they do many mergers. And then I combine this with high operating margins. So I said, if you are buying good value, if you're paying much less than value, and you keep doing this, your operating margin will stay high. But if you overpay and you buy the wrong company, then your operating margin will go down after the mergers. So I look at companies that had high goodwill to assets and high operating margins. Mm-hmm. And then I rank them by this. And what I find is that the high goodwill and high operating margin companies outperform by 1/3 the other companies.
Interesting.
And if you look at the article, you know Lawrence Cunningham?
I'm not sure. I'll have to check.
He written a couple of books that Buffett loves.
Okay.
He was doing a parallel research on quality shareholders.
Okay.
So he said, good quality companies attract good quality shareholders.
Yeah, for sure.
Who are long-term investors.
Yep.
So what we find is that the companies that I choose as run by value CEOs are the companies also he found that have good quality shareholders.
That's awesome.
Because, most people think that CEOs have to be good operators. And most of them are good operators. What they're not good is they're not good asset allocators.
Right, capital management.
Capital management, right? Because they didn't learn this. Most people, went through the various functions in the organization. They know how to operate, I guess, all these things.
Exactly.
But they don't know how to invest.
Mm-hmm.
And CEOs have to invest because they got all this cash. They can buy back shares, they can pay off debt, they can buy another company, they can invest in R&D. These are all investment decisions. Okay, so how do you allocate your capital? Mm-hmm. And they're not good at that. And so my research tried to find, I guess, good asset allocators.
Do you think that's the most important job of a corporate CEO?
I read, because you asked me this, so capital allocation is a skill that most CEOs don't learn. Mm-hmm. And so they become CEOs without mastering capital allocation. This is what you can see this in the Berkshire Hathaway annual reports. And this, according to Mr. Buffett, and I quote here, can create a big problem for a business because the CEO will often not know how to make critical decisions that will maximize shareholder value. In the book Outsiders, William Thorndike refers to capital allocation, and I quote, as the CEO's most important job. Yeah. And then Buffett says here, quote, it would be a terrible mistake if capital allocation were not a made talent of his successor.
Well, I guess that answers my question then. But, if you listen to somebody, say, for example, Elon Musk, he's actually critical of that approach towards a business, and he considers something like innovation to be the most important part of a company and CEO's job. What would your thoughts be on that?
This is part of my checklist, right? I want CEOs who are innovative, reinventive, because many say to reinvent the company.
Yeah, exactly.
I mean, Nokia, mm-hmm. before they went into cell phones, mm-hmm. they were making tires.
Really?
Tires.
Yeah.
Actually, in Finland, there's still a division, I think, of Nokia making tires, where they're called Nokian.
I didn't know that.
Yeah, so you've got to be, CEOs are very important, especially if a company has no barriers to entry, the CEO can make or break the company. So when I talk about sustainability and competitive advantage, I look at the CEO. I say, has the CEO being innovative, adapted to change, adapt to change, reinventive? So when I look at the companies, I want to look at his experience, his past work experience, what he's done, I guess, the education, all these kind of things. But that's one checklist.
I see.
So yes, I don't say this is the most important thing. I think it's a very important thing.
Okay.
And capital allocation, could be part of this because I allocate capital in new technologies, right? That's part of my investments.
I see.
Because one of the things I said before was investing in R&D.
Right.
Well, I want to invest in R&D because I want to innovate in this area, right?
I see.
So innovation is part of your capital allocation decisions.
What to you makes a good business? For example, Peter Thiel might suggest proprietary technology, whereas someone like Warren Buffett would suggest a brand or the ability to delight your customers. Do you think there's a difference between those two?
I have here somewhere what Buffett says. Let's see. So Buffett says, well, first of all, let me just start from the beginning before I say Buffett. So for me, there are companies that operate in a free entry environment. Most companies operate in a free entry environment. I think 90% of the companies operate in a free entry. And then 10% of the companies operate with barriers, within franchise. Companies that have no barriers to entry, companies that operate in a free entry environment. For these companies, the most important thing is management. Or I should back up one step. Companies that operate in a free entry environment have to try to become the most efficient companies in the industry. And who is the agent of efficiency is management. So companies, I think, with the best management tend to be the best investments, I guess, in a free entry environment. The only problem with management is it's difficult to replicate.
It comes and goes.
Yeah. And that's why I said, okay, look at whether the company has good succession plan programs and internal training. Because you're going to sustain this management by good internal training programs, succession planning, trying to be a role model. So that's for me, that's the best indication of sustainability. I think Stella Jones in Canada had an excellent management, but he retired, I guess, last year. But they had a good succession plan. And the new CEO actually was an insider who was trained and moved up and understood the business, understood the culture. You cannot, for a company that's doing well, don't bring outside management. Okay, bring within, train within. It's only the bad companies you need to bring outside management. So that's for the companies in a free entry environment. I think the best management probably and sustainability of management is important. For the other companies with barriers to entry, you need to build a franchise. Okay, you need to build a moat. And Buffett says 3 things build franchise. One is that the business is not subject to price regulation. Second, has no substitutes. And third, you make something that people want or desire. I think all of this, but for me, what creates a franchise? What gives you barriers to entry? What prevents, I guess, the competition?
That's what a good business is, right? One that's over the long term.
First of all, there are many things, I guess. Maybe a combination of all these things. One is you've got technology, proprietary technology, know-how, patents that allow you to produce at a lower cost than anybody else. Okay, so even when the other guys don't make money, you still make money because the lowest cost producer. Another thing is, so that's from production side. From the demand side, do you have a customer advantage, demand advantage? That is captive customers. You have a way to keep the customers captive. Are there switching costs? That is it difficult for people to switch out of this? software is a business, is a product that is very high switching cost.
Mm-hmm.
And you got to be able, I guess, to defend these things. Okay, you got, Microsoft or banks try to make it difficult to switch by adding new features. Other companies like Rogers Cable or in the cell phone business, they make it difficult to switch by making things so difficult to compare.
Yeah.
People, will not spend the free time trying to compare price, features, service, all these things. If they're not that happy, they will just stay with them. Of course, also economies of scale advantage. You got to be not only to be big, but you got to be higher market share than the other guys. High market share gives you lower average cost. And of course, nowadays the most important is network effects.
Yes.
Companies with network effects are winner takes all. My question in my mind is, are we eventually overpaying for these companies? Because I don't think the government will allow any company to be the only company. You're young, maybe you don't remember this, but Microsoft, the government tried to break Microsoft back in the 90s, I think. And eventually there were 10 years, 15 years of court cases. Eventually they did not break down Microsoft, but they slowed down the growth of Microsoft. And the same thing they try to do now with Google, with Facebook, right, Amazon. So that's, I think, you need to build your moat. You need to build your franchise.
Right. I guess it's too simplistic to view it as a brand versus proprietary technology. Like there's different ways to build a good business.
Well, brand is important as long as cannot be duplicated.
Yeah.
I mean, like Mercedes-Benz had a huge brand back in the 60s. But then you got the Japanese that replicated the quality.
Right.
They had BMW and Jaguar replicated quality. So the brand did not really help very much the market value of Mercedes.
But what's interesting is you compare a company like See's Candies, one of Buffett's favorite investments, but then you compare it to a company like Facebook, where it's like technology, and then you have just a candy business. And so it's a different definition of a good business, I guess.
I mean, it's a combination of things, right? It's a combination of things. And the more of them you combine, the better you are.
Right.
Because, companies with network effects, they become more valuable the bigger they become, I guess. So that is, they become more valuable to people the more people are using the products, basically. It's like, I mean, if I have Facebook and I'm the only one with Facebook, it's not useful. The more people have Facebook, the more useful it becomes to me, right?
Mm-hmm.
And so these guys become so big that the average cost becomes so low.
Yeah.
They become very profitable.
When you're looking at businesses, do you look towards a certain type of business when you're valuing companies for investments? For instance, a See's Candies or a more traditional business like that versus technology companies like Microsoft and Facebook, or do you care?
One of the most important things in valuation and investing is to understand the business. If you don't understand the business, the models can be nice, the math can be nice. If you don't understand the business, never going to do it.
I see.
So it's easier to understand, I guess, civil manufacturing business than understand like high-tech business. Right?
Mm-hmm.
I mean, if I was an engineer, maybe I would understand them better, but I don't understand them very well. Okay. So I try to stick, I guess, with things I understand. This is what I tell my students. And choose 4 industries to understand and understand everything that you need to know about these industries.
You've probably met most successful value investors in the past 50 years. I mean, Canada and the U.S. Do any of those particular people stand out in general to you? Are there any that really rise above, other than, say, maybe Warren Buffett?
I don't want to mention names. I think the names I mentioned already, to me, I think your audience can go onto my website, bengrahaminvesting.ca, and go on the videos. I have invited the best value investors that are alive. Actually, some of them are not alive anymore.
Yeah.
In my mind, were the best value investors at the time. And so they can go, rather than me telling them who they are, they can go and see how they like them. I mean, because most of them, are very humble, very shy, not really type A or beating the chest. They're people you like, and this is what makes value investing interesting, Value investing, and this is what I tell my students, value investing is not only about investing. It's also about lifestyle. patience, discipline, long-term focus are traits that define your personality, your character. And these traits help you be successful as an investor, but also help you having success in life. Yeah. Because they allow you to live a more balanced life. And this balanced life makes you also live longer. That's why I say another benefit of value investing is lets you live longer.
Right. I've read that. Yep. Did you ever study someone like Phil Fisher, Common Stocks and Uncommon Profits?
I think Buffett was motivated by this as well.
Yeah, exactly. Yeah. Did you read Phil Fisher much?
I read it. I mean, most of them, the same with Ben Graham's book on intelligent investing is very simplistic, I guess. They don't have any formulas, don't have any things. They just talk to you about the philosophy.
Right. Okay.
The approach, yeah.
Okay. Did you incorporate that kind of philosophy into your investing style too, or were you more strictly Ben Graham value, or?
Yeah, no, I mean, as a Ben Graham investor, you can make more money.
Okay.
The only problem is that you've got to be on top of the stocks every day. You got to look at your stocks every day because these stocks can be very volatile. The quality investing, I guess, allow you to sleep better at night, but will not give you as high profitability as the Ben Graham. That's why if you look at Warren Buffett, most of his, people say, he made 24% of the last 50 years. Well, most of this 25% happened when he was a Ben Graham investor.
Yeah, for sure.
After he became a quality investor, he slowed down.
That's interesting. I have his reports. I've read. I tried and read all of them. They're right here actually.
So I mean, it seems that you're very passionate about value investing. Why you don't try to manage money as opposed to being?
It's hard. I mean, I guess it's a combination of I know how hard it is to beat the market, and
it's hard, yeah.
It's also hard to get people to give you money to manage your money. So I've always thought about that career path, but like I said, the best way is to start with your own money and grow it from there. So.
Well, this is how Francis Chu started, right? Francis was an immigrant from India, and he came to Canada. He started working for Bell Canada, and then somebody gave him the Intelligent Investor to read, and he just clicked. And he started investing his own money. Then he took some of the money of his colleagues at Bell Canada. Then he realized he was doing very well.
Yeah.
He quit and started his fund. Friends and family first, like friends and family. And then if you're successful, the word spreads out.
Yeah.
Pretty fast.
Getting back to how many people actually beat the market though. I mean, everyone has their, they think they can, maybe make 10, 11% a year.
Of course.
But like maybe half a dozen people that actually do it.
Well, I mean, it's fashionable to say you are a value investor. I mean, if you look at the websites of companies, they all say that we're value investors, right? But most of them are not. In one of the visits to Buffett, actually the first time I went to visit with Buffett, my students, he was much younger. So I said to him, how many students do you want me to bring? He said, bring as many as you want. So because as he was getting older, he was limiting the number of students. So we arranged the plane, and I took down 120 students with me.
That's cool.
And so we go up to the boardroom, and then he comes in, and I think some question was asked about success in investing, and he said, I hate to say this to you guys, he says, but out of you 130 people here, maybe 2 or 3 will make it.
Yeah, exactly.
And also, people are asking me, they say, well, you graduate every year 200 students in value investing. Don't you think that all the opportunities will be eliminated? I said, no, because not all of them will be successful value investors. They don't have the temperament.
For sure.
Only, 1 or 2%, they will do well.
Have you seen any younger students that you've graduated manage money well?
Yeah. I mean, actually, so the Ivey Value Fund is managed by students, actually.
Yeah. Okay.
And they're not very well managing my money, managing the university money.
Right.
And I've got some other students, actually, that still keep in touch with me. And actually, I had a Zoom with one of them yesterday. Yeah, but not too many, right? I mean, I've been teaching value investing since 2005. So if you multiply, 15 years by 2 other students, that's a lot of students, right? But maybe Actually, one of them, he's starting his own fund now. Ariel Barel.
Okay.
He's starting his own fund. Very good guy. So I keep in touch and I follow maybe 10 of them.
Yeah, I mean, that's not many.
Yeah, not many.
Interesting. Do you read the Berkshire Hathaway report every year?
Not every time. I mean, I've been to the annual meeting as well, but I find it exhausting, just exhausting.
Yes.
Too many people,
Right.
too aggressive, I mean, the Americans are very aggressive. Very aggressive. I mean, I remember one time we woke up 4 a.m. to go and line up to get in there. My value investor friend, who had been there many times before me, he says, George, when they open the doors, don't stop to help anybody. Even if an old lady falls, don't stop to help her. But ask for to get the seat. So I went in there. So he went on. I said, you go on that side, I go to that side. Whoever finds the best seat, we call it the other person. So I go there and I find a nice seat there, two seats. And now I'm standing up in front of my seat. I'm trying to look at him. Two guys come behind me and sit in my seat. I said, what are you doing? He said, yeah, but you're not sitting.
Yeah, that's amazing. That sounds not very pleasant. Maybe it was interesting. I don't know. Like I said, I like to read the reports every year, and I've kind of.
Yeah, I mean, I read also the Fairfax reports.
Ah, yes, right.
Yeah. Yeah, it's always a good advice. I mean, Buffett writes in a way that makes enjoyable reading it.
Yes, he's one of the best writers I've ever read, to be honest.
And he has this, one sentence words, sentence lines that you think about them. So, oh my God, this is really deep.
Yeah, like I said, I have most of them here. What's the best investing advice you've ever gotten?
Again, what makes someone a best investor is the personality. I mean, it's nice to be born with a personality, but most people are not born. So you've got to develop strategies. You've got to build strategies to deal with the weaknesses in your personality, in the human nature. And I tell people, most people think always in binary terms. That is, for example, let's say you want to lose weight, and always ask yourself after your main meal, your main course, you say, should I eat dessert or not? That's a binary decision. What if you said after main course I'd never eat dessert? Then you don't have to choose. For me, I say after 9 p.m. I don't eat. So this is what I say to people, to train yourself. Never make impulsive decisions. That is, always look before you jump. No matter who told you that, okay? Step back, think about this. There's not, should I do what my brother-in-law says or not? I don't really do what you tell me, okay? I have to take my time, think about it, do my in-depth analysis, and then do it. Never make impulsive decisions. Second, always think of the opposite, which again goes against your human nature. You tend to, like last March, everybody was running. That was the best time to invest.
Yeah.
But human nature, this is what our human nature is. When we see risk, when we think something is dangerous, we run away from it. But it doesn't work with investing. Okay? In investing, you've got to do the opposite. You've got to think of the opposite. That's why Seth Klarman says that in the long run, the consensus is always wrong. A third, you've got to develop an analytical process. That is what I described before. Step 1, screening. Step 2, analysis, and in-depth analysis and valuation. Step 3, the decision. Because this analytical process helps you overcome your human nature. Because if you follow this process, you know when to buy, when to sell. There's no emotions more involved, Then always write down a piece of paper. What are the things you want a company to have before you invest in? A checklist. Do they check all these points? And checklist, as you know, is good to have when the risk is high. But that's why airline pilots have a checklist.
Yes.
The risk is high. Also, surgeons have a checklist because the risk is very high. And always, and I said this before, always talk to a knowledgeable friend, someone you respect, someone who may be better than you. Never be afraid to ask questions. I think all this will help you train yourself.
That's awesome.
To become an investor. And this is the advice I got. This is like an overall advice from talking to all the people, basically.
How much do you think of investing is just sitting at your desk reading annual reports? Is that, say, 80% of the job?
If you look at the day operation, what they do in a day, 80% of the time is reading.
Mm-hmm.
Reading annual reports, reading press releases, and why you do this? Because you want to understand, I guess, what's happening. Is there smoke out there? Because if there's smoke, there's fire.
I think a lot of people, maybe myself included, get intimidated by a lot of the geeks with spreadsheets and whatnot. But I think a lot of times investing may be an accumulation of just simply reading a lot too, in a lot of ways.
Yeah, if you look at my academic book on equity valuation, I've got a spreadsheet there. I've got a link to a website, and I got 24 interlinked spreadsheets. For value investing, you only need one spreadsheet.
Yeah.
Back of the envelope stuff. It's not so complicated, okay? You don't have to really forecast and think what's going to happen 10 years from now.
Mm-hmm.
You just use the history as a guide to go forward.
Hmm.
And you need to understand, rather than go and do all formulas and spreadsheets, the best thing you can do is understand the business model, the overall picture, as opposed to all these numbers. And I tell my students, I don't want you to give me any spreadsheets, I don't want you to give me any numbers and formulas. I don't want quantitative analysis, I want qualitative analysis first.
Hmm.
And if I like your qualitative analysis, I will look at the other stuff. Otherwise, I will not look at the other stuff.
Do you think the average investor is still better off just to put their money in the S&P 500? But for anyone getting started, what would you say would be one of the best steps? Just to start reading lots of annual reports?
Well, understand business.
Okay.
Try to understand business.
Yeah.
Look at some industry you may be able to understand, and then read all about the companies in this industry to see what differentiates them. Okay, what drives them? What's the business model? How they make money? An index.
I'm sure you've seen that bet that Warren Buffett made on the fund of hedge funds that was outperformed by the S&P 500 over a 10-year period. I mean, most hedge funds can't even beat a standard Vanguard fund.
Yeah, another problem is with money managers is that, even though many of them can be good investors, what they care more about doing what the right thing is, what they care more about is not losing their jobs or not losing assets under management. Mm-hmm. So they don't want to go out on a limb. They say, the safest thing for me to do is stay close to the index and become closet indexers.
Right. Yeah, exactly.
And of course, if you're a closet indexer, you're never going to outperform, right?
Yeah.
And most studies that you read in newspapers and academia is studies that are not done very carefully, and they took, I guess, all mutual funds, and only half of them were closet indexes. So you cannot really, after fees, show much on the outperformance.
Yeah.
But if you look at other studies that looked at narrow funds, like 15, 30 stocks, mm-hmm. they tend to do actually well.
Well, it's been an awesome conversation.
But, like I said, I have this book coming out. At this point, I'm going to test drive the book with my students for some final things, and then look for a publisher sometime in May.
Right, yeah, for sure.
This book, like I said, is the only and the first academic book in value investing. It tells you basically how to find intrinsic value. I'm not just giving you a description, Most of even if you look at my the videos of value investors, they don't actually give you the exact template.
Yeah.
They just tell you, because they don't want to give you the competitive advantage, right?
Okay.
So in my book, I show you exactly what you do. I've got an internet-based model that can help you do various scenarios. And then I have two actual companies that I value using these templates, this framework. So so you read the book and then you go and say, this is how we apply this in this actual company. So I think people will make a lot of money out of this book. And so when I talk to publishers, I say, you know, how much are you going to charge for the book? And most of the books they sell for $20, $30. When I tell them I'm going to charge $300, they say,
Yeah.
holy cow, you're going to pay $300. Well, if you are 20 years old and you're not going to make a lot of money by the time you become 60, well, $300 look like a very small number, right? So
maybe that's the right strategy. It's a high price.
You know, like the margin of safety sells in eBay for $1,200, right?
Well, that's a really good conversation. I really appreciate you taking the time, and I could talk to you for a couple hours probably, but I won't.
Yeah, I've got to leave too. I've got a thing to 12:30.
It's hard to find people to talk to about value investing, it seems. I don't meet many people that I've read Ben Graham and Walter Slaw, Seth Klarman, so thank you. Is there anything you would leave a listener of this podcast with before we wrap up on investing? Any maybe core piece of investment advice?
No, I mean, I already said, understand yourself and go and do in life something that is consistent with yourself, with your personality. Don't force yourself to do something that does not make you happy.
Yeah.
Because of marriage, of kids, make sure you do something that makes you happy. Because if you do something that makes you happy, you don't ever want to retire. And you're going to be a happy person. And you're going to live long.
Well, that's great. We can end the podcast there.
Okay, well, Trevor, thanks for doing this. I think we need to have more people like you spreading the word. I wish you all the luck, best of luck with your company and with your podcasts.
Hey, thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. You can also find our coffee and chocolate there, where we plant one tree for every bag or bar sold through our partnership with One Tree Planted, a cool not-for-profit organization focused on global reforestation. Until next time, happy coffee drinking.